We now bring on board Vikas Khemani, President and Head of Institutional Equities with Edelweiss Securities. Vikas, good morning. Thank you for joining us. Vikas, yes, Indian markets closed on a high note on Friday. But if I look at the broader environment and if I map in market internals, things are not looking all that charged up. News flow is strong. Policy initiatives have kicked in. Earnings by and large have been above estimates, but still Indian markets are lacking that momentum. Why is that?
Good morning, Nikunj. I think it's a very valid question you raised. But I think if you see, Indian markets ran ahead of all these events, expecting that these events will pan out. It ran ahead of good quarterly earnings, improvement in the asset quality. It's all those things I think sort of was expected, and markets are sort of those events are panning out. And typically you see in markets the markets play out the new sort of rumors or expectation in advance and sort of consolidate on the actual event. And this is what is precisely happening. Having said that, I am not making a point that the run is over and good news is over. I think as sort of all the good news or all the expected events have panned out, markets have consolidated after a sharp run. And I think probably there might be some correction also, because there could be some profit booking after a sharp run. Stocks have run up between 40 to 80% depending on the sector and stocks. So I think that is bound to happen. Also, I think one has to see what kind of follow-through happens. I think we have seen somewhat disappointment in the monetary policy in the last 3-4 times. So I think that tomorrow is the policy, so market would want to watch out what kind of signal RBI gives. I think 25 basis point kind of thing is already factored in, but I think anything plus or minus would be sort of surprise for the market, and I think markets will react to that accordingly. So I think you will also start seeing now sort of somewhat expectation getting built to the budget. And I think that probably will start panning out, in my opinion, early part of the next month. Until then, we are pretty much expecting market to sort of consolidate, remain in a narrow range. That's I think probably summarizes the market currently.
Because given the recent policy initiatives, do you think oil marketing stocks and especially names like ONGC, they are a must buy on heavy decline?
I think the recent reform has been a very, very positive move, and I think it's very sort of move in the right direction, and we have seen stocks doing well post that. Now the challenge I think will be, in my opinion, before buying those stocks, one needs to see whether these reform process will be carried out or not. I think whether full deregulation, the structured deregulation will continue in a sustained manner or not, especially given the election season probably in the late part of this year or early part of the next year. So I think that will be the key call. But I would tend to think that at least this momentum will continue for next 1 or 2 quarters. And if you are looking to buy with that kind of perspective and possible risk, of changing towards the election, I think that could be a good way to look at it. In my opinion, these stocks would remain buoyant and I think positive at least for 1 or 2 quarters, and then positive news flow will continue in them.
Because do you think the best part of the pre-budget move is behind us, or given the kind of global and local environment we are in, markets are on course to touch a new high before budget?
Nikunj, I think I would tend to think that probably we are on a course to touch new high before budget or around budget. I don't know if it will be before budget or after budget, but I think my whole hypothesis around that is I think global environment is fairly good, global liquidity scenario is very good, and I think government is all set or sort of all out to sort of make reform process a reality, and they are doing step by step most of the things that they have promised. And I would tend to think that budget would be a good document in terms of outlining fiscal consolidation, in terms of showing reasonably good amount of growth. And I think and most of the fronts, such as I think divestment schedule, and I think a timeline for GST implementation. So you will see a lot of statements coming out of the budget, and in my opinion, unlike popular belief, budget will not be populist. Budget will be a fairly balanced budget, and I think based on that, I feel that if I were to juxtapose between a global environment and sort of possible budget coming, I definitely think that probably before in and around budget or before March, you will see market getting into a new high. And I think lots of foreign investors who've been waiting to see a sort of way forward in the budget would probably again come in and invest money.
But Vikas, where do you think the leadership is going to come in from? Is it going to be the rate sensitive lot in particular banks which are going to lead the market higher?
Yes, I think we've been maintaining that I think leadership has to come from the banking, because banking is a very large sector, and I think that is also kind of coincides with the interest rates coming down and asset quality improvement, which is directly linked to the reform process carried out by the government. So if you see policy reforms, that has impact on the banking. If you see interest rates coming down, that has impact on the banking. If you see growth coming back, that has impact on the banking. So I definitely think that banking is likely to lead the rally, which so far also has led the rally. So that should continue. Also, some of the sort of infra names which so far has not participated, any clarity around, I think those issues would sort of also contribute in that. So, and also according to us, metal sector also could be a very good sort of dark horse or surprise for the markets to perform. We've been pretty bullish on the metals given the recovery in China, and I think given the fact that these stocks have been, I mean, you started seeing some amount of margin improvement in these stocks. So I think you will see that also kind of contributing reasonably well to the index.
If I map the general environment for real estate, the environment is not strong. But if I look at the real estate stocks from the recent lows, all of them are up a good solid 50 to 100%.
Absolutely. I think, Nikunj, what happened, real estate stocks got completely hammered and I think got written off as a sector in last 12 to 18 months. But I think if you see, I think this sector is interest rate sensitive. So as the interest rates are coming down, markets are making bet on that. Secondly, there are select stocks where I think you see a lot of value given their land stock, given the fact that the cash flows have started coming, you will see them doing well. So some of the stocks which are very leveraged and large amount of debt is still there, they haven't done as well as stocks which are sort of less sensitive or sort of less prone to the debt mounting. So I think if you see highly leveraged players in real estate have not done well, low leveraged players have started doing well, and especially with the visibility of good land back and good cash flow getting converted into cash flow, I think you will see that. I think most of the south-based players, in Prestige, Big Ed, I think all of them have started doing well. Whereas if you see players like DLF has not done as well as some of the smaller players. So I think clear distinction is being made into the players where you will see the land bank getting converted into cash flow. And I think that there is definitely case to be made in those kind of sort of names. And real estate as a sector is interest rate sensitive, and as interest rates are coming down, I think will do well. And I think best way to play this will be go to the select stocks where you see cash flow visibility coming out, and I think make your bet there. And we are positive on some of the select names out there.
Between Maruti and Tata Motors, which is a better stock to own? For Tata Motors, it's JLR. For Maruti, it is weakness in the yen.
Well, I think, Nikunj, from a recovery perspective, I think we would be more keen to, look at Tata Motors at this point in time, while Maruti, we've been positive on both stocks, frankly speaking, so, and both are different plays. Maruti is a play on the, cars, and Tata Motors are on the more commercial vehicle, and if the recovery in the economy happens, I think commercial vehicles also will do well. And I think, as you rightly pointed, from international perspective, JLR versus yen. So I think we've been positive on both the stocks, and I think it really depends on what the investor wants to play. But frankly speaking, from our sort of preference point of view, we prefer Tata Motors over Maruti, and I think it just again that can vary from the risk reward perspective, but I think because we are expecting some amount of recovery in the sort of domestic CV space over the next 3 to 4 quarters, and that could lead to somewhat positive movement for Tata Motors. But again, I think, as I said, that both stocks we are fairly positive at this point in time.
Because, okay, now there is a logic in why you should buy infra names, because they're beaten down and recovery is the big theme for 2013. But after the recent run-up, how's the risk-reward ratio stacked up for some of these infra names?
See, I think if you look at most of these infra names, have sort of reason on expectations that there will be a policy reforms, and I think, especially in the power sector. And I think so they've run up and they've also corrected post those run-ups. So the point I think I'm trying to say that the large part of the run-up is led by the only expectations. I think the follow-through run-up or delivery of the performance will happen only after we see concrete actions on the part of the government to make carry out the reform process and make sure the sector works well. And I think that process is on. But I think given the nature of the sector, the complexity involved in the sector, I think that cannot get sorted out in a short term. That will take time. But I am reasonably confident or hopeful that I think government is working on that, and you will see somewhat action being taken to create the logjam in the sector right now, which they are going through. So I think this expectation versus real delivery will, I think, continue for some time. And in my opinion, I think the high risk, risk-averse investor will not still jump into it till the time action starts taking place. But I think, in my opinion, some of the investors who like taking high beta, risky stocks, they would kind of start making the exposure to these sectors, and somewhat they have made already. But in my opinion, they would continue to make exposure to this sector. So it's clearly risk reward. Depending on what kind of appetite investors have. I have seen some of the aggressive investors kind of betting aggressively on these names, and and averse investors staying away. But in my opinion, next 2 quarters you will see somewhat action happening in this sector, and especially in the power and road sector, and anything happening there would really will be very, very positive for this sector, these stocks in the sector.